Good morning, everyone. My name is Trent Zimmermann. I am the annuities director here at BGA Insurance. And my background, I have a bachelor's with background in economics, master's in finance. I'm a chartered financial consultant, and chartered life underwriter. BGA is a top GA in the country for life insurance, annuities, long-term care, and disability. And this is your 20-minute Annuity Tuesday. And this week we're talking about private equity. Now, before I get in, um, I want to caveat a lot of this. That the thing I hate most joining these webinars is turning it on and getting the me monster. Having somebody stand up there and say, I figured this out, I solved this, I did this, I do this with my clients, and you should follow everything I say. Um, it's it's exhausting. And I hope that that never comes off this way when I'm doing these, because the goal of this has always been to take the best practices of our agents, information that we get from carriers, and our access to product developers and executives to try and give you what you need to leverage to make more sales and work better with your clients, protect them better, and be able to serve those clients better. I don't want this to be the Trent show. And what we're talking about here with private equity has taken a lot more research on my side from academic papers, uh, government resources, great journalism, and some books that I've been compiling together to create this presentation. And because of that, the opinions are going to be of my own. And so you might disagree with the conclusions I come to. You might have different opinions. I invite that. You can call me and argue with me later. But if you have a difference of opinion on what you want to sell after this, then what I would recommend, just let me know, because that will help me attune to you and make sure I'm recommending what you have as your goals and what you want to be providing for your clients, as opposed to just defaulting to my recommendations. So with that, I want to go through bibliography first, which I don't normally do, and just show you here some of the resources I'm going to, and you're seeing here as well. It's going to be the books, academic resources, journalism, and government resources as well. And we're talking about private equity, and I know you guys know what we're talking about here, but for those of you who may not know, I'm just going to start off with some definitions, and that's going to be private equity is going to be an investment management company that raises capital from institutional investors, high net worth individuals to acquire, restructure, or invest in private companies. Typically, they take controlling stake, looking to improve operational efficiency over 3 to 7 year periods, sell for a profit. That's the baseline we're all going to start at. And we're looking at the Blackstones, the KKRs, the Apollos. This is outdated information. This went up to 2023. They have continued to explode in their assets under management since then. But we're talking about the holy grail right now for these companies. And that has been investment funds that do not need to be returned to investors on a timetable or at all. That's private capital, as what private equity is deemed to be their holy grail. And the life insurance and annuity balance sheets are well suited for this because every product has a little bit of money dedicated to the general account, which is essentially their endowment to keep these companies afloat. They also have the investment funds within this that need management. And in many cases, the cost of servicing liabilities is significantly lower than the potential investment return. So there's margins there that they can continue to play with. Uh, so that's why we've seen an explosion in terms of PE companies, private equity companies investing in life insurance and annuities. All five of the major PE companies have assets in life insurance. It ranges 15 to 50% of their total assets under management being inside life insurance and annuity companies. They outright own 12% of life insurance and annuity assets in the United States, totaling 620 billion as of 2024. Again, this has continued to explode into 2026, and they represent more than a third of US net written premiums of index annuities. So they're major players in this market, and that's why I wanted to talk about this today because it's changing the annuity landscape, and we need to be aware of what's going on. The playbooks are really one of two options, and oftentimes both. The general partnership model and the outsourced chief investment officer. With the general partnership playbook, they're doing equity investments, sometimes in conjunction with other investors, sovereign wealth funds, to acquire and then reinsure the books of insurance companies. They want to achieve stronger investment returns. They do this by rotating the asset allocation to higher risk, hopefully getting higher return, and hopefully achieving higher alpha. The research on this has been within 3 years of acquisition, 80% of these insurers had increased their allocation to asset-backed securities, primarily in collateralized loan obligations, and over 50% of their investments were in private loans, compared to 37% of the industry. The industry standard being 37% invested in private loans. Outsourced chief investment officer model is pretty standard. They may have an equity investment in that company, and they may not, but they're going to be managing the books. And they're claiming that this is going to be improving the IT of these companies, improving the technical excellence with investment risk underwriting, maybe commercial uplift with marketing budgets, and franchise growth into new markets. Do I buy this? I don't know. We've seen improvements on paperless applications, accelerated underwriting, doing this all online on a web basis. Um, we've seen greater marketing on some of these. Does that lift them up? But in terms of knowing what markets to go into and how to bet to look at the actuarial table of somebody's life and their mortality risk, I'm not quite sure that a private equity firm knows better than a insurance company. And I think we can look at the disasters of Phoenix Life and say they probably don't. Um, but that gets us into the apparent risk that we're looking at level three assets, conflicts of interest, and self-trading. And that's what we're going to be diving into because they are going to be considered smart money. So they're going to be less regulated than you and I would be, and don't need to play by the same rules. They're institutional investors, accredited investors, and so they're going to be investing in level three assets, financial assets and liabilities that are considered to be the most illiquid and hardest to value. So what we're going to be talking about really is private credit. Uh, its strategy of investing in private companies and making non-bank loans to them, not available in public markets. Their goal is to generate larger returns. Um, and this is typically with mid-market companies. And it's rampant throughout it. I shouldn't say rampant, it's not a bad thing. It's it exists throughout the life insurance and annuities market, but these private equity firms are more and more becoming private credit firms. And as some economists have said, if this news cycle the last year wasn't so noisy, this would be all we would be talking about the possible collapse of private credit. But there's a lot going on. You'd be forgiven to not know what's going on there. But there is some research out there about private credit. We're looking at an average 9.5% return. That's going to be higher than your bonds, lower than your equities. And the default rate is since 2008 when they started researching this, about 1.01%. Now, of course, that's higher than your government bonds, but considerably lower than corporate and lower than high yield. So right now we're looking at higher returns, lower risk than your corporate and high yield. And uh, with a standard deviation in price, that's comparable to Treasury fixed incomes. And when we're looking at duration of these, we're looking at 3 to 7 year loans. Um, and so these theoretically would be great assets to put in an annuity where your time horizon is 3 to 7 years. You're getting higher returns at lower risk. And when we look at the correlations of this, about 45 to 50% is related with equities, around 10% to 13% related with treasuries, and the rest is related to the underwriters who are assessing this risk. And the SOFR rates and debt to equity ratios, um, and the provisions in how they're going to be managing this when they take over the company and put in professional managers. That makes up the remaining 40 or so percent. You could say that this is a great asset to build into those fixed income investments, because when you're looking at the cap par rates and how they build it, uh, they're looking at these fixed income assets to create the budget that they take their profit out of and then build the options budget uh, from there. So if we have something that's detached from this 10-year treasury yield largely, more consistent with equities, um, you could theoretically create something that could get higher yield, higher cap and par rates for your clients, and not be as affected by the interest rate market. However, all this research has been done on Cliffwater Direct Lending Index, which has publicly available information, public balance sheets and audits that have been released from publicly traded companies doing this, or court filings, and then self-reporting. The issue with that is, if you are following the Wall Street Journal's investigation of this, we're looking at these private equity firms claiming they're under 25% in tech investment in these private credit markets. And now we're seeing that they're well over 5% higher than they were self-reporting. And they're reclassifying these tech companies as wholly different companies. And we're starting to see, because of that, people start pulling out because the default rate is higher than expected. We hit, I think, 2.6% on Blackstone's investment. And we're also seeing that these private equity companies are sitting on $1 trillion of un-IPOable assets. And Blue Owl is capping their private credit funds redemption at 5%. So they're not allowing people to pull money out. And I thought I had one more in here, sorry. And we're looking at a situation here where people want their money out. We have these private equity companies with sitting on a large amount of assets that they can't IPO, and they're not classifying well what they're investing in for their loans. So are these private credit type of deals bad for the insurance? No, not necessarily. But when you have this structure with private equity where they're able to say, I'm going to invest in companies that I'm going to provide loans to companies that I'm invested in that I can't get rid of, can't get off my books. Um, and the default rate is starting to climb. I'm more interested in giving myself sweetheart deals uh, and moving money from my left hand to my right hand. In terms of these loans, there's no third party oversight of these companies and how they're providing these loans. Uh, we could be possibly entering into a doom cycle here where more people want to pull money out. We're getting more exposed to what is going on inside these loan agreements. Uh, and it continues to feed into the cycle of default rates and more people wanting to pull out. And what does that mean for these companies? Uh, are they going to be able to fulfill on their promises to your clients? I don't know. And a lot of this is I don't know. They aren't, they're not transparent on how they're running these companies and what they're doing. And it's a spectrum. There are companies out there that are private equity owned, and the private equity is, in a sense, just a TPA that's managing a pension and is looking for long-term investments. There are private equity owned companies that produce uh, renewal rates on their products and provide financials. But then there's plenty of private equity companies that are completely opaque and we don't know what's going on there. It all exists on a spectrum, but where I'm getting on this is there is so much opportunity uh, for self-dealing and conflict of interest, especially when you add on the layer of outsourcing the investment. And we look at these volatility controlled indexes, where that volatility controlled indexes are controlled by the private equity that controls the company. So they're being paid on the transactions that are happening within these funds on a daily basis. And we see those largely returning about 2% over the last 10 years, but they're still making money on the trading. It's just getting to the point that I'm not trusting putting clients in this in definitely not in an index play, likely not in a fixed index accumulation play, but maybe I would be okay with it depending on how the company handles renewal rates, the term on the product, and what information they publish about their investments. But I would be fine with them on a MIGA because there's so little moving parts and such high guarantees that it'd be hard uh, to get out of that. And maybe we would look at them in the SPIA, but I would tend to recommend against them on accumulation in a fixed index asset or guaranteed lifetime income rider, especially for the guaranteed lifetime income rider because those are riders, they're seen as secondary to the contract until uh, that income is fully annuitized. So that's a risk that I wouldn't want to put your clients under. So I know that's me riffing at the end and providing a lot of my opinions. But we're looking at an opaque situation here, where these private equity groups are looking at investing in annuity companies to provide permanent capital that they can reinvest back into companies that they are invested in and can't IPO out. And that is more and more seeming like a dangerous situation to be invested in. So, with that, I know I'm going to end early. I'm going to give you 3 minutes back in your day. And I know a lot of this was vague and just a general warning against it. But reach out to me if you have any cases. I will always uh, put forth three options to you, and that's how I like to work. And I'll give you the best one for it if it's income, um, whether it's private equity or not. But then I'm going to give you my recommendation after that of something that's not private equity, sound company, uh, provides its financials, has a good alert score, which is a great way to track financials that can't be gamed, as well as the AM Best can be, uh, that produces renewal rates that I think your client would be best in. And then a third option that might be good for a different reason. If we're doing an income solve, maybe it has an income doubler built in there. Um, so take down my information. If you need the fact finder, I know we've been pushing it a lot. It's a great way to get started with your clients and be able to provide that information back to me so we can make the best recommendations possible. And a little housekeeping before we close out at the 30 minutes, or sorry, 20-minute mark. Next week, we are going to be having Mass Mutual come in and do a presentation. And Steve Jones in our office, who is starting a life insurance version of this 20-minute Tuesday on Thursday. He will be hosting that one and introducing her. And I'll be back 2 weeks from today, and I'll be doing it on a strategy there of home equity usage that works in, albeit a small amount of cases, but when it does work, it can really help somebody who's low on cash in their retirement. Then we'll go back to outsourcing, talking to you guys, hearing what you want to see next on these Annuity Tuesdays. So with that, shoot me an email if you want that fact finder. If you have a case, if you want to learn more about the companies that are private equity owned and ones I would stay away from, and ones that I would recommend, we can do that offline. I just don't want to put them on blast here since we're supposed to be impartial about our recommendations of companies in our marketing. So With that, I'll give you your day back, and that's been your 20-minute Tuesday. Thank you all.